Good morning, everyone. We will start the webinar in a couple of minutes. Good morning, everyone. It's great to have you all here. Today, we are discussing a question that's on most of the investors' mind. Why is your portfolio is in red? Uh, so, seeing the investment decline can be a frustrating and even more stressful, right? But often the reason behind a struggling portfolio are within our control. Let's explore the major factors that could be holding back your investment. The first reason is that your portfolio may not be goal oriented. Many investors jump into the market without a clear investment strategy. They buy stocks based on trends, news, or recommendations without aligning their investment with their financial goal. For example, if your goal is to create a long-term wealth, investing in a fundamentally strong companies or a diversified mutual fund is essential. On the other hand, if you need money in a short term, putting all your funds in equity market might be risky. Ask yourself why I am investing. Uh, if it's for retirement or a house or a child's education, your investment should reflect your timeline and risk appetite. A well-structured, a goal-oriented portfolio prevents from panic during market downturns and ensures long-term growth. The second reason why portfolios struggle is the lack of timely reviews. Stock market is dynamic and so are businesses, interest rates, inflation, and even global economic conditions. If you invest and forget, you may find yourself holding on to underperforming assets while missing better opportunities. Regular reviews say every quarter, reviewing like every quarter or like yearly, help you to rebalance your portfolio. Maybe a particular stock has gained significantly, making your portfolio overweight in any one sector, or like an asset class isn't performing as expected during an adjustment. For instance, with the recent FIS sell-offs and the global uncertainties, uh, some portfolios need reallocation towards defensive stocks or even gold or bonds to balance the risk. Without reviewing, you might be exposed to unnecessary risk or underutilizing your capital. Uh, yeah, so there are several key factors which are contributing to the current situation. and can broadly categorize them into four areas like global trade tensions, FII behaviors, domestic challenges, and currency fluctuations. So let's dive into each of these factors and understand their impact. Global markets are highly interconnected, and any geopolitical or a trade-related conflict can have a ripple effect, whether it's on the ongoing dispute between major economies like the US and China, or the rising protectionism, or a disruption in the global supply chain. These tensions create uncertainty in the market. For instance, if large economies impose tariff or a restriction, it affects the global trade volume. Here I'm referring to the US tariffs thing, what's going on with Mexico, Canada, and China, impacting India's exporters and industries such as the IT, farm, and manufacturing. So investors fearing volatility may pull out investments and lead to market correction. Foreign institutional investors play a significant role in the Indian stock market. So when FIS invest, market rally. This you can see in the recent Morgan Stanley index inclusion of the bond. So the bond demand has risen. So similarly, when they sell, market correct. Later the FIS have been offloading stocks due to multiple factors like the interest rate stuff, the strong dollar, and the global risk aversion. So particularly if I want to say, for instance, if you see the US bond yields becoming more attractive, FIS shift their capital to safer assets, leading to outflow from emerging markets like India. This FIS selling put pressure on indices like Nifty and Sensex, resulting in, you can see what the widespread market decline. While contributing factors like other factors like even domestic challenges like market volatility can be something due to the slow economic growth, inflation, kind of disappointing corporate earnings, or even kind of policies which are not certain. If I want to say, like for example, if inflation remains high, RBI may increase the interest rate and making borrowing costlier for businesses and individuals. Similarly, if corporate earnings fail to meet the expectation, investors' confidence takes a hit, leading to market correction. The policy decisions like taxation changes or the government spending cuts also have a direct impact on the market. Suppose if any particular sector there is the kind of any cut in subsidy in any particular sector, it would have some great impact on the stocks of that particular sector. Then lastly, the fluctuation of the Indian rupee against the US dollar, which is another key factor. Weakening rupee makes imports more expensive and increasing cost for the businesses that rely on the kind of goods such as oil, electronics, and machinery stuff. Weak rupee also affects FIA sentiment since foreign investors earn in dollars. Depreciating rupee erodes their returns, prompting them to sell Indian assets. This in return puts further downward pressure on the stock market. So here in this slide, you can see that how a 400 plus return which has been created in a span, but which also has undergone a lot of corrections. So this is how the market works. So to have a kind of a long sustaining return, you should undergo some kind of drawdowns and some kind of crashes. So as when we see the current crash, what we are right now undergoing, so when we see the Nifty, it has fallen around 15 to 16% from September 26 to 2024, which is the peak of Nifty. So it's not that bad as what we are seeing in the slide. So to get some good return, the market should undergo correction. So it's important to be more patient and more goal oriented and stick with your own strategy. Don't change kind of when you see such kind of big slides, you should not get deviated from your goal. That's very much important in this current market. In adding point to the previous slide, you can see that the current kind of drawdown of around 43% is not as bad as what we have seen in earlier period. So the kind of a drawdown or a market kind of getting lower is part of the kind of a stock market cycle. So it's important to be more patient, more diversified, and more goal oriented, and keep reviewing your portfolio timely. That's very much important. So, we have discussed why our portfolio may be in red and the key reasons behind the broader market downturn. The big question now is what should we do? Should we panic and exit, or should we take a strategic approach? The answer lies in four key actions like diversify, rebalance, look for opportunities, and being patient. Let's break this down one by one. Diversification is the golden rule of investing. If your portfolio is concentrated in just a few sectors or assets, a market correction can hit you very hard. For example, if your investments are mostly in technology stocks and the IT sector underperforms, your entire portfolio have a big hit. Instead, by diversifying across sectors like banking, financial services, FMCG, or pharma, you can reduce your risk. Additionally, diversification is just not about only equities. Investing in debt, gold, REIT, or international market can also help you to protect your wealth during downturns. Rebalancing is about realigning your portfolio to maintain your desired allocation. Let's say you originally allocated 70% to equities and 30% to debt, but due to the market correction, your equity value has fallen to 60%. This means your portfolio is now more debt heavy than intended. Rebalancing in such situation, either by investing more in underdeveloped stocks or adjusting your asset mix, ensures you stay aligned with your financial goal. This is not the timing the market, it's managing your risk. A downturn is not just a challenge, it's an opportunity. When historically market corrections have created some of the best buying opportunities for a long-term investors. For example, during previous crashes, quality stocks such as which corrected sharply, but later delivered a massive return. The key is to identify fundamentally strong companies trading at a discount and invest them systematically. Good approach is so uh, which allows you to invest consistently and take advantage of your price over time. And lastly, the most important factor is patience. The market moves in cycle and downturns don't last forever. If you look at history, the 2008 financial crisis, the 2022 COVID crash, even the recent correction we all are seeing, right, which all are temporary. Investors who stayed invested and held on to good companies saw their wealth grow significantly when market recovered. But equally important is what is to avoid common mistakes that would damage your financial growth. Here are some four key mistakes that investors often make. Stopping SIPs, do it yourself, invest without knowledge, falling for the narratives, and not actively participating in opportunities. So let's go through them. The biggest mistake investors make in a downturn is stopping their SIP out of fear. Market correction lower stock prices means SIPs buy more units at lower price, which benefits you in a long run. Historically, those who continued SIPs during bear markets saw much higher returns when markets recovered. As I want to say, for example, someone who stopped their SIP in March 2020, that is during this COVID, they missed out one of the fastest market recoveries in the history. So stay invested, let the compounding do its work. Do everything yourself, investing without proper research or experience can be very risky. Yes, self-learning is great, but investing based on random YouTube videos, Telegram tips, or social media hype can lead to poor stock selection and unnecessary risk. Instead of relying only on the self-study, seek expert advice, consult financial planners, or invest in a diversified mutual fund. Uh, Even when you see the experienced investors rely on expert insights. So it's important to balance DIY effect with professional guidance. Market narratives can be dangerous. if they influence your investment decision without a solid research. There are some stuff like the crypto will go only up. So that's kind of a narrative we used to go through, right? But after 2021, the crypto crash, it's gone. Similarly, tech stocks will never fall. It was the kind of narrative which was there until the dot-com crash. So instead of following this market noise, focus on fundamentals, company performance, macroeconomic factors. A good investment decision is backed by data, not by hype. Correction is a golden opportunity, but many investors sit in the sideline waiting for the perfect time to enter the market. Let's be honest, right? Timing the market is impossible. Instead, those who consistently invest in quality stocks and mutual funds during downturn create wealth over time. So yeah, remember market reward actions with discipline. The best investors buy when others are fearful, and that's how long wealth has been built. So from now onwards, Harshil will take over the webinar. Harshil, to you.
Thank you, Ram. Okay, so we all have this question of which is the best way to invest in a volatile market. Of course, the best way for in any market is going to be your SIP, and Ram covered it very well. That usually in a falling market, you get that amount of that level of fear comes in where you find that the amount that you're putting in via SIP is at risk, so we should not be putting in the money. But SIP is such a product, and we covered it probably in the previous webinar also, where the data was very clear. So it does not matter where you start or when you start, at the peak of the market or the bottom of the market. Your returns by the end of your tenure, say 10 years or 12 years down the line, is going to be somewhere between that 12.5 to 13%, right? Irrespective of where you start, the value would be different, but your growth rate is going to be very similar, right? So SIP should be the best way for you to be able to weather through a volatile market. And on top of that, volatile markets give you asset prices at a much cheaper cost, at a much cheaper price, right? So hence, you should be participating some amount on top of SIP in a falling market, right? You don't need to time it. You do not need to wait. It's some amount, right? So if your SIP is going for 1 lakh, so 10,000 rupees, 10% of it should go as a lump sum, 15% of it, depending on the market scenario, right? That's how it should be, right? So these small incremental sums of money is just adding on to you able to buy these businesses at a much cheaper cost, right? Or those funds at a much cheaper cost, right? You're able to gather more and more units at a cheaper cost, right? So you're just trying to get your average a lot more better, right? And it does matter in the long term. So the more you're able to acquire at a reasonable cost from that angle, let's say your goal is to your goal is somewhere between 10 to 12 years, it automatically gets cut at least by 6 to 8 months, right? So that's the entire objective. The minute you are able to reach your particular goal, that balance amount, right, the faster you reach your goal, the balance time that you get in your hand is time spent for wealth creation once you meet a particular goal, right? So that is an added bonus point, right? Ram, you can move on to the next slide. Okay. Uh, Sorry, I think there are some certain comments. Ram, can you project your presentation again? I
Yeah,
don't
yeah,
think
I'll
that's
just do
it's
that.
visible to some.
Yeah, sure, sure. I assume it's visible right now. Harshil, you're in mute right now?
Yeah. Understand your entire risk profile. How do you invest smart? The first thing is to get completely aware about what sort of a saver and what sort of an investor you are. Right? You have to understand your risk profile, right? And during a bear market is when your actual risk profile comes out, because that is when you see, oh, I cannot take a 15% drop, I cannot take a 20% drop of that or, of that entire size. Right? So I would only suggest that yes, continuously every market is where you have to keep taking your risk profile test again. That's one. Second, when do you take a risk profile test again? As you grow, as circumstances keep changing in your life, as you keep progressing forward, right? Because your goals will be different, your goals will be larger, different goals. It requires a different mentality, different way you perform towards meeting that particular goal. Hence, understanding your risk profile is extremely important if you want to be a smart investor. Second, have all your bases covered. This is something that we repetitively, it might be very repetitive, it's boring, but wealth creation is boring. Right? You need to have 6 to 12 months of emergency reserve. That is your first base. On top of that, your insurance needs to be covered. Right? Your base is what gives you that ability to take on risk. Otherwise, just focusing on one asset class, and like Ram pointed out, saying diversify, and he was talking more from a point of diversify across sectors, but actual diversification means uh, investing across all asset classes in different time frames, right? Because some asset classes perform extremely well. Your gold has performed extremely well over the last 3 years. It has done much more better than equity in the last 1 year, right? So it's clearly visible. So there will be certain periods where asset classes, different asset classes perform uh, much more better than the other asset class. So there will be that opportunity that you will get across the board. Hence diversify. So hence your emergency fund, your insurance, your entire defense has to be extremely built so that it gives you and pushes you to take on risk. Your ability to take on risk starts going up. Right? Third, review your finances and your goal. Again, this is extremely important. If you do not have your finances at your fingertips, and you're not disciplined and you're not able to channel your finances right to meet that particular goal, you will not be able to grow your wealth as a household, right? Making sure that you're having your finances on your fingertips not only gives you an idea about how much money you will be able to put in the market when things get bad, but also certain categories are meant for certain goals, right? So emergency is meant for immediately liquid, right? So there is some where you need some level of passive income, you need something to be on the debt fund, right? So on that part you cannot touch that money, that is just for passive, right? So that you're able to get some added money to meet your particular expenses, right? Some has to be for growth. So if you don't have that level of understanding, then please please meet us. We will be able to help you out in understanding what your goal should be, how much it would be required for you to meet your particular goal. And we always look for you to always review it, right? So the whole point is that every year, every 2 years is where you get a thorough understanding of how the market works and then how your life is evolving and progressing going forward. Hence, more gold keeps on getting added, right? So how can M2W help you? One is we will be able to help you in managing market volatility. Market volatility is not at all new. Every equity markets are volatile in nature. You will see bouts of downs, you will see sudden bumps up. That is the nature of the market, right? So we will help you in managing market volatility. Most important out of the three is we will help you to stick to a particular financial plan. We do not want to work with anybody who does not have a financial plan, right? Or does not want to have a financial plan, right? So the whole idea is that no, we want to make sure that there is a particular goal, there's a particular milestone that you want to achieve, be it 2 lakhs, be it 5 lakhs, be it 10 lakhs. But the whole point is that you need to have a particular goal. And only then you will be motivated, only then you will see visible results pushing you to go to the next milestone, right? So we will help you to stick to a particular plan. We have an entire team here on financial planning that will help you in understanding what your goal should be, how much would be required to meet your particular goal, and get you on that journey going forward, right? Third most important thing, we help you take away all this emotional decision making. How do we do that? We have constant webinars this way. We have one-on-one discussions that we do. We have in-person meets that we do, which is group meets, via conclave. And we put out a lot of content on social media from all our handles. which is completely knowledge driven, right? So we are completely transparent. We are very opaque. We are very open in telling you about what you should be doing with your money, right? All of these channels are going to help you in avoiding making an emotional decision. Why you need to avoid making an emotional decision is because it disrupts your wealth creation. That's why SIP is the best method. It should be the base for investing in the equity market fund, because it avoids that emotional. And if you put an emotional decision on top of something that is already disciplined in nature, then that is a bombshell waiting to destroy your wealth creation. Right. Ram, you can go to the next slide. Right. So I was talking to you about the risk profile. So what do? We help you understand your risk profile. We make you take a financial health checkup, where you can understand your entire ability to save. You'll get a clear picture about where your household is right now and where your wealth needs to be 10 years down the line. We've set a target saying 1 crore should be the first milestone, and after that, we can work with you for bigger milestones going forward. So understanding your potential, growing your potential. Right. From our side, what do we do? Sorry, from your side, what do you need to do? One, patience, I think Ram already covered. So patience is something that you need to show. Wealth creation does take a good amount of time. Your first 3 years in the market will always be volatile, right? I would say 2 years. The third year, you automatically get accustomed to it, and you know how to react to it. You know how to participate well in markets that are currently shown to you, right? Staying invested is something that you have to do, right? It's taking out your wealth out of a particular asset category only happens when that asset category has reached its entire potential to perform, right? Usually that happens, in cycles. Everything works in a cycle. So at the peak of the cycle is when you move to another asset category, but never not being invested. Staying invested always in different categories, different asset classes, right? And as you see yourself being able to meet particular goals, you will be motivated to do a lot more. So our entire job is to make sure that once we are able to meet that particular goal for you, you are on that journey and on that track to set goals yourself, and be motivated and be encouraged to keep doing. Right. Now you can go to the next slide. Right. So this is the entire model. This is the cycle that I was talking to you about. During boring markets is where your participation needs to definitely go up. It has to go up by lump sums. It has to go up by SIPs. It has to go by step-up SIPs. It can be a combination of two. So lump sums plus SIP plus step-up SIP. So it can be a combination too. But the whole idea is that your participation level needs to go up in a bad market, so that when the time comes for exciting markets, you can reap that benefit. And this is very true for different asset classes. In equity today, we are not yet in an extremely boring market. We are still say somewhere after the exciting market, right? It doesn't look like it is boring right now, but the exciting market is definitely not on the cards for some time, right? So at that point, you tend to reap those benefits when the exciting time comes. But this is the time where it requires a lot of participation from your side going forward. Right. That whole journey of you being able to meet that 1 crore is very, very simple. This is all public data. It takes you 8 long years to get to your first crore. If you're just being consistent by doing 70,000 rupees every month, very conservative rates of 9 to 12%. And then it takes you 4 years for the next crore. So 8 for the first, right? For the second, 4. For the third crore, it only takes 3 years. So by the time you reach the 20th year, you're adding 1 crore every year. So it's not just a 1 crore goal that we're putting you on. 1 crore is just the starting milestone. And the behavior that it takes for you to get to a crore is going to define how your journey is going to look like 10 years down the line after that. So look at that. Your first crore in the 8 years, 10 years after that is 10x. Right? That's how compounding works. But your first score is extremely important as a milestone. So we will start slow. We will get you to 2. We will get you to 5. We will get you to 10, then 20, then 25, then 50. So you will be on that journey where you have to get to that 1 crore. That's the target that we are setting for each and every single one of you who we want to work. Right. I think now we can open the floor for Q&A. We already got a question. Which sectors are more or less immune to tariff wars? No sector is that way immune to tariff war. Right. Countries are not immune to tariff wars, so sectors also definitely not going to be immune to tariff wars. Okay, there's a comment on consumption. Consumption and tariff wars. See, if there's a blip in, income going down, then definitely it does affect consumption. But this time the tariffs have been majorly, reciprocal in nature. It's not that it's happening. It's just that you reduce the tariff. We'll put a tariff if you don't reduce the tariffs that are being given to us. So it's a win-win sort of a scenario for both. Right? Where today morning newspaper also it has come, right? What sort of trade needs to take place between two countries, and how it should take place. So it's general trade negotiations. These are. Okay, there's a question on pharma sector is attractive now, right now to invest. Uh, Not so much. Maybe you can hold on for that. Okay, which fund is better in volatile markets? Dynamic asset allocation, conservative hybrid, or equity savings fund? See, again, it depends on your risk appetite. So that's why I keep telling first, I think we should take a risk profile test. Once we understand what sort of a saver you are, what sort of an investor you are, we are anyways following a multi-asset approach, right? So on the equity, we'll make sure that a certain amount of risk is managed well. On debt, we will make sure that a certain amount of risk is managed well. And on other, which is more precious metals oriented if required, debt is managed very well. Right. What is the best way to invest 10 lakhs now if I have to start afresh by booking existing losses? Not mutual fund, direct stocks. I mean, no, you need to do only mutual funds. If you are out of your total wealth, right? The first crore is very important for you when you look at equity as an asset category for you, right? So until then, you should stick to doing mutual funds. Mutual funds is more tax efficient if you just want to, compare and see whether it is a PMS or whether it is uh, direct stocks. And you do not have the time to do direct stocks. If you do not have more than 4.5 hours, uh, in your day where you can spend to do a lot of research work, then you should not do direct stocks. You should just give it to a professional manager who has been through the market. Which is what we also do, right? When we are looking to do mutual funds uh, as an investment, we only stick to the ones that have gone through multiple cycles, who know how to invest, right? They have a lot of experience on their hand, and we are getting them at a very cheap cost. Yeah, your expense ratio is barely 1% or so, right? 1.1, very it's minimum. So as the AUM goes up, that also will go down. So when you're getting the best professional advice at a cheaper cost, then you should stick to do that, right? So my only suggestion is you should look to the mutual funds. Okay, you said keep your goals in your fingertips. Reels comfortable. Okay, can you suggest me one mutual fund, please, at the current situation? We will have to take a risk profile test to understand what sort of a saver you are. Can you take risk? Can you take risk or not? So once we do that, we can help you get onto a particular plan, and then we start out doing the mutual for you. No issues. But there are multiple checkpoints that we need to do for you to understand your whole scenario, and only then. Otherwise, here, if I just give you a name that it's not going to suit you. Also, for us, everything that we're doing here is tailor made, right? So what is required for you is what we will do. What is required for another investor, we will do that for them, right? Everything goes through checkpoints. Everything is there are checklists that we follow internally, right? Okay. Uh, okay. There's a follow on. Thanks because of the recent rally in gold, multi-asset gave returns over 12%. But if commodity perform lags in future, multi-asset may lag behind dynamic asset allocation, equity savings. No, it's not like that. See, we also run a multi-asset strategy on the mutual fund. Plus, we have a PMS that is completely multi-asset, right? So Rham is also on the team for the multi-asset PMS, right? So it's not that it will underperform. Once you diversify across asset classes and you do not have a cap on a particular asset category, right? You will be able to maintain and be consistent. Basically, stability is what we're looking for when we look to do multi-asset, right? Lower drawdowns, that doesn't mean no drawdown. Lower drawdowns and stability is what we look for when we look to have a multi-asset approach. Not that we want to do a multi-asset fund, but having a multi-asset approach. So and they have this cap, so that much. So suppose, like you said, right? Suppose because gold has had a great run, and for the next 1 or 2 years it does not really perform, right? Suppose. So the fund compulsory has to put it, but for us we do not have that compulsion. For us, we can redirect that because we have no cap. We can go 0 to 100 in any particular asset class, be it on the mutual fund side or be it on the PMS side. Why we have that on the mutual fund as a no cap sort of scenario? Because opportunities are completely different. Sometimes it warrants, given your risk appetite. If it warrants for you to go overweight on the equity, we go overweight on equity. If it does not warrant, then we choose a different strategy to have a mix of or more overweight towards the debt or a conservative asset class for you, right? Where you are able to compound somewhere between 9 to 12% by having lower drawdowns. The problem is that even if you do Nifty and be passive in life, over 10 years, you still make 9% on return, compounded. That's what the index usually looks to do. But your drawdowns are higher, and the risk of drawdown gives people a lot of acidity. So that is what we want to maintain, right? Not having too many drawdowns. Okay. Should our lump sums be in a staggered manner in this market? Do you expect us to build our cash reserves for the future? See, cash is something that the mutual fund manager will already maintain. So you do not need to do cash management on your part, right? But what you need to see from your aspect is the finances and your savings for what is going to get generated for the year. Then we will decide whether we have to do it in a lump sum or a staggered manner, right? So it does not depend on what I'm telling you to see is see your finances first, then look at the market. If your finances are very sure, you're sure that you will continuously keep getting flows during the year, then a lump sum warrants, but you have to have finances in your hand. Okay. Why large cap funds are more red compared to other funds? Because large cap funds will be stable. Large cap funds compared to small and mid cap funds are not in uh, red. Basically have not fallen more than mid and smalls. Mid and smalls have fallen more. Thematic funds have fallen more, and large cap fall has not been large. It's not. It's not too deep, right? Okay, what percent of cash do we need to have at the current juncture for any further fall? Is there any strategy to deploy cash in the? I've already answered this. That's why I'm saying Nifty is just a benchmark for you to see. What you need to see more and above this is your finances. If that's why I said, if you are having your finances at your fingertips, that during the year I'm going to get this much cash flow in my hand, right? And you're certain of it, then this level definitely warrants some amount to go as a lump sum. Then again a lump sum, then again a lump sum. But you need to have uh, your finances determine your participation, not the Nifty. Okay. Gold is at all-time high. Silver price ratio looks attractive now compared to gold. Your thoughts in investing in silver at this time? See, we on the PMS and on Milestones2Wealth, we for investors who had that appetite to take on risk, we had taken both these investment decisions for them. And right now, I would say you can stagger and go slow, but you cannot do this without a clear understanding of the metal. Uh, Given today's scenario for geopolitics and tensions and how gold has seen that extra coming in, and it's not. I mean, it's a little. You don't usually see gold to be volatile on the way up, right? It's stable sort of commodity, right? So from that logic, you should probably stay back and go a little slow on these two asset classes. Okay, there is a question on how will you find which sectors will underperform before it starts underperforming? So for years, banking had underperformed. 2020, 21, 22, and at that point, fundamentals were definitely the indicator for us to invest in those themes. Why? Because when you see that during 18, 19, and 20 were crisis years for the whole banking industry for India. And after that, even after COVID, you did not see our entire banking system go down. It's not from a stock price perspective, but the industry itself did not get affected by it, right? So when you see, fundamentally things are looking extremely good. So price is just one particular action. So your stock price movement is, or fund movement is always on. Yes, it's the fundamental moving. Yes. What is the narrative? What's going on? And then when the hype comes in is when you see when two things work for you continuously. But this takes time, for narratives to change and people to look at it. This is improving. That is an extremely good thing. So the value of that particular asset becomes much more. Right. So we look at the past only to see how things have been. But in terms of opportunity, we are always forward looking to see what are the how do things develop and how are things evolving, and does it warrant for us to pay that level of price given that particular growth rate. If it fits, it comes to you. If it does not, then it does not come to you. So we have actively stayed away from small and mid caps for since 18 was the last time. After 18 there have been no direct investments into small and mid caps apart from certain sectors. Certain sectors like infrastructure, because infra was underperforming, right? So if price movement is the and valuation is the highest and the biggest indicator for us when we have to think of underperformance. Okay, why are people averse on small and mid cap funds? See, you're paying a lot more for the growth that is being given. The expectations are very high, right? When expectations are very high, usually people are not very cognizant of valuations. They'll just pay whatever they want to. Now, if I know what the cost of this shirt is, why would I want to pay 2,000 rupees when I can get it at 700 rupees? Simple. So just because there's some level of madness or some level of behavior that is happening, that doesn't mean that we have to follow that. So that's why there was one very good thing that say, don't follow the herd. But we never follow the herd. We are contrarian in nature. Okay. Anyhow, that will bounce back one stage if you have enough duration. See, I'll ask you, you can reply to me and then I'll get back to you with that answer. What do you define as enough duration? What is duration? How long is your entire horizon? Right. How do you invest in gold, SIP or lump sum? Right now, I would be a little cautious. When the time comes, I think lump sum would do. But right now, I think if you do not have it, then do not try to chase it. When the time comes, you will. If you're on the program, you will get uh, you know messages, and the team will always get in touch with you for when opportunities arise. But if you're not on the program, then uh, I don't know what is the best way to reach out to you. But so get onto the program. We'll be able to get in touch with you. We'll be able to help you, guide you in that particular manner. Your prognosis of dollar versus rupee. See, currency, that's why we are talking more on the gold and commodity front, right? Because currency is extremely volatile, right? And what the RBI has done over the last 3 weeks is that they have stepped into the currency market. They have made sure that we are not very volatile, right? They're very clear that they do not want it to be volatile. So where we used to depreciate somewhere between 3.5% a year, now it is reducing. So that's the idea, that it though it will be a free market sort of a thing, but they will come in to control the volatility, right? And dollar is an overvalued currency given the current the way it is going on. Dollar looks like a overvalued currency. Okay, I have started direct stocks and mutual fund. Mutual fund SIP in gold ETF, silver ETF, couple of thematic funds, IT, pharma, Nifty 50, direct stocks, major banking, few large caps since the portfolio is easier. Portfolio down 2%. How do you see my portfolio? Because many portfolios say that they are down 15 to 20%. Uh, See, the reason why your portfolio is not down by too much because of SIPs into gold and silver. That has protected your drawdown, right? Uh, we have seen drawdowns on the not major drawdowns on the banking and on large cap, right? Why? Because they have been undervalued for a good amount of time. So enough when you look at it from a valuation band, it's fair, cheap, very cheap, fair, expensive, very expensive. And if you're able to get it during the cheaper part, it usually tends to become cheaper in such falls and all that, right? But more or less, your downside is covered after that. So when we see portfolios down 15 to 20%, it's in the building stage. It's not that they have done something wrong. A loss doesn't mean that they've done something, or an unrealized loss is not something that they have done wrong. We have to sit, We have to evaluate to see, okay, are there mistakes being made? Okay, if it's a yes, then it's a definite problem, right? If it's more on the behavior front, then behavior only needs to be managed very well. That's it. So when you work with a professional, they will only talk to you more on the behavior front. So we always talk to you more on behavior. We never get into more of the funds and what is this, what is that. No, because when you have a target for a crore and when you want to get to that, your behavior is what is going to get to you, not the returns. Because otherwise, 12 to 15% usually, is good for when you have to compound wealth over a very long period of time. But how to get that is majorly on behavior. Right? So you'll have to sit down to understand, why that drop has happened. Is it, if they've just started, you can let the SIP run, no problem at all. Okay. Difference between pure value investment and value with growth investment. Okay. What is value? That's why I gave you that example for a shirt, that when you know what the value of that whole entire product is, or the service is, why would you pay higher? Every investment is a value investment. In your life, you are already practicing value investing. You will go and bargain out, whether you buy fruit or a vegetable. We are bargainers, right? So we will always look for, if a growth investor is or a growth investing, that is equity is a growth investment, right? So we will just have to cherry pick what we want to invest in and then say, okay, this is not a price that we want to pay. Let's hold on, let's chill for some time. When we get that level, we will look at it again. If there's something extremely, say, for example, when we look at solitaire, which is our flexicap product, there the mandate is that we will only look at market leaders. So when you get a market leader, at a relatively cheaper cost in its history, then we go all in. Otherwise, it's a staggered approach, right? So that is the pure, everything is value only. We are all value investors here because that's what we practice. That's what we are made to practice in life. Right, it's the growth component that and the ticker symbols and the price at which it keeps on going makes us believe that no, we should only follow this. But we are all value investors. Everybody is. So do you think this is the best time to book losses and correct our mistakes by existing if the portfolio is down 20%? No, we will have to review to see what you have done. Right. So you can send us a hi saying that I want to review my portfolio in this number, and our team will get in touch with you. Again, we need to review it. We need to understand what you have done. If it is something that has been done without good amount of work, without a good amount of research, then definitely it warrants an out. If not, then it is a hold. But we need to review it. And uh, this is something that we have to do one-on-one. It does not mean that it's just because it's down 20%, it should be sold off. We need to understand, what has happened, right? Okay, please suggest parameters like PE to filter down bad stocks at this juncture. PE itself is not the only indicator and the right indicator, right? Uh, the E is always in a bull market, the E is always overestimated. So the P always, the denominator is overestimated. So the whole thing looks like it's very cheap. Okay. So to understand how E is, that in-depth work of 4 hours needs to go in a day for that particular business, for that particular industry, right? So to get the E right is the whole sort of game. So there's no, you cannot just go to screener and put a filter and say, no, this is bad, take it out. We have bought businesses that, so when we had bought PSU funds were 8, 9 P. It was nothing when we had invested in them. So the E went up, so it looked very cheap. I think it was 13 or something when we had started investing in it. It became 5, 6 and all that. So the P went up drastically because the E was overestimated, in a bull market. So don't think that it's only one way to look at things. There are multiple ways where we look at things, and yeah, PE is one of the characteristics, but not the only thing that we look at. Any other parameter that is the most important according to you? Yes, your household savings ratio is a the most important parameter that you need to look at, right? This has nothing to do with stock investing or mutual fund investing and all that. Go back home, see what your income is, how much are you spending in a month, at the end of it, how much are you able to save? If you're saving somewhere between 40%, then how do you get to 50% as your first milestone? Then how do you get to 60% as your next milestone? Somewhere between 65 to 75 is a great number to have. That is the most important parameter that you need to see. A P, PB, EV, EBIT, no, don't run behind that. That's not going to give you return. You are going to give yourself return. That is the whole game. So we have time, probably two more minutes to take on more questions. I think there are a couple of questions on this. No, okay, all are covered. If there are more questions, definitely happy to address them all. If there are any queries that you might have later on, what sort of direction you should be taking, just hit us on this number. Just send us a hi on WhatsApp, and our team will get in touch with you. If you're not on the program, get onto the program. There's a lot that we are doing in terms of content. There's a lot that we are doing in terms of plans. There's a lot that we're doing in terms of in-person meets as well, right? And now we have had the women only platform and program as well, which I think Archana and Aishwarya are taking over. So you will see a lot more content coming from our side, uh, for solutions for need based uh, solutions. That's it. So we are doing a lot more. So get onto that program. Okay, then Ram, let's close. Done. Thank you so much all for joining in. Have a good day ahead.
Yeah,
Thank you.
yeah, thank you. Yeah.